Right now, the U.S. housing market looks strong on the surface. Home prices are near all-time highs. In many cities, prices are still rising, and headlines keep telling us that demand is resilient. But when you zoom out and look at the data more closely, a very different picture starts to emerge. Because underneath those record prices, affordability is the worst it's been in over 40 years. Inventory is rising in key markets, and price declines are already happening, just not everywhere at the same time. That's why today's market feels so confusing. Some cities are getting cheaper, others are still going up, and buyers are stuck trying to decide whether they're early or already too late. What this video will actually answer. So in this video, we're going to cut through the noise and focus on three things only. First, where home prices are already falling right now based on year-over-year data. Second, why national prices could start trending lower over the next 1 to 2 years, even without a full recession. And third, and most importantly, what this means for you, whether you're thinking about buying, selling, or staying on the sidelines. Because predicting the housing market perfectly is impossible, but understanding the direction of risk, that's absolutely doable.
Seasonality. Before we talk about crashes, we need to talk about timing. U.S. real estate follows a very predictable annual cycle where prices rise and fall in consistent peaks and valleys every single year. Historically, buyers are most active during the spring and summer months, while activity slows sharply in the winter. That timing alone explains why prices often feel stronger in the middle of the year. According to Redfin, this pattern is largely driven by weather. Cold and wintry conditions make it harder for buyers to attend showings, and sellers know that homes generally look better when landscaping is green and days are longer. As demand rises in the warmer months, more buyers enter the market at the same time. Competition increases, and prices are pushed higher as a result. Redfin's data shows that seasonal price differences typically range from 8 to 12% between winter and summer sales. In certain regions, especially the Northeast and Great Lakes, that gap can be as high as 22% between peak summer prices and winter lows. This also shows up in transaction volume. Nearly 70% of all home sales in the United States take place during just a few peak months each year. According to the National Association of Realtors, sales activity jumps 34% between February and March, while prices rise by about 3% during that same period. The busiest months remain June, July, and August. And this is why seasonality matters. Right now. Rising prices in the summer don't automatically mean the market is healthy, but when prices start falling during peak season, when demand is normally at its highest, that's when the data begins to send a very different signal.
The 18-year real estate cycle. Now, before we get into specific cities and price declines, it's important to address one of the most well-known long-term theories used to analyze real estate cycles. It's called the 18-year real estate cycle, and it was originally identified by British real estate economist Fred Harrison. This theory suggests that housing markets move in repeating 18-year patterns made up of 14 years of expansion followed by 4 years of contraction. According to Harrison, these cycles have shown surprisingly strong accuracy going back to the late 1800s. Using this framework, he correctly anticipated the housing downturn in the early 1990s and later the crash in 2008, both well before they happened. And based on that same model, he believes the next major downturn could occur around 2026. Each cycle begins after a crash, during a period of recovery. Demand is weak, confidence is low, banks are cautious about lending, and new construction slows significantly. Prices stabilize, but growth remains limited. As the recovery continues, demand gradually returns, rents begin to rise, inventory is absorbed, and builders start increasing construction to meet growing demand. This phase typically lasts several years and feels relatively healthy and stable.
The next phase is where things begin to accelerate. Prices start rising faster than fundamentals, speculation increases, and buyers begin purchasing not because homes are affordable, but because they expect prices to keep going up. Some refer to this as the winner's curse, where people buy simply to avoid being left behind. Eventually, that demand starts to weaken. Overbuilding leads to excess supply. Buyers step back expecting lower prices, banks tighten lending standards, and sellers begin reducing asking prices. That's when the contraction phase begins and the cycle resets. Of course, this model is a simplification. Regional differences, government policy, interest rates, and investor behavior can all shorten or extend parts of the cycle. Even Harrison himself has said that the next downturn could play out differently than in the past. But if the cycle holds, the timeline becomes interesting. The market began recovering around 2008 to 2012, followed by roughly 6 to 7 years of moderate growth from 2012 through 2018. A mid-cycle slowdown appeared in 2018 and 2019, with several major U.S. cities experiencing temporary price declines. After that came the final expansion phase, lasting another 6 to 7 years, which would place the peak of the cycle around 2026. That doesn't guarantee a crash, but it does suggest that the market may be entering a much riskier phase, where price growth becomes harder to sustain and downside pressure starts to build. Where home prices are already falling. Up until now, we've been talking about cycles, theory, and timing. But this is where the conversation shifts from abstract ideas to real-world data. Because price declines are no longer hypothetical. They're already happening in multiple parts of the United States. One of the clearest patterns right now is geographic. According to Business Insider, Florida and Texas are leading the country when it comes to price softness. These are the same two states that built more homes than any other region in the U.S. over the past several years. During the pandemic, Florida and Texas saw massive population inflows. Remote work, lower taxes, and warmer weather drove demand to historic levels. Builders responded aggressively, increasing construction to keep up with the surge in buyers. But that surge didn't last forever. As prices climbed and mortgage rates increased, affordability in these markets deteriorated quickly. Homes that once looked inexpensive compared to coastal markets suddenly became much less attractive. As a result, many areas within Florida and Texas are now dealing with a supply-demand mismatch. There are simply more homes available than there are qualified buyers willing to purchase at current prices. This is what typically happens late in a housing cycle. The markets that grow the fastest tend to be the first to cool. Rapid development, combined with slowing demand, creates downward pressure on prices. When we zoom in to the city level, the trend becomes even clearer. Realtor.com recently identified 11 housing markets experiencing the largest year-over-year price declines in the United States. At the top of the list is Miami, where home prices are down 11.2% compared to last year. This is notable because Miami was one of the hottest housing markets in the country during the pandemic boom. Miami experienced rapid price appreciation, a surge in new construction, and a wave of investor activity. But as affordability worsened and inventory increased, demand began to soften. That combination has now translated into measurable price declines. Next is Denver, where prices have fallen 6.3% year over year. Denver saw significant in-migration over the past decade, but rising prices and higher interest rates have priced out many buyers. Seattle follows closely, with prices down 5.5%.
Tech-heavy markets like Seattle are particularly sensitive to changes in financing conditions and buyer confidence, which makes price adjustments more likely during periods of uncertainty. Other cities on the list include Kansas City, down 4.9%, Oklahoma City, down 4.3%, and San Jose, down about 4% year over year. These declines span multiple regions and price tiers, showing that the slowdown is not isolated to one part of the country. Even some of the most expensive and traditionally resilient markets are beginning to show cracks. In Manhattan, average sales prices have declined by approximately 3%, driven largely by a rise in available inventory. There are now about 9.8 months of housing inventory listed for sale in Manhattan. That level officially qualifies as a buyer's market, where supply significantly exceeds demand. This doesn't necessarily mean prices will continue falling at the same pace. Some of these declines could be temporary, and local conditions still matter enormously. But what's important is the broader signal. When multiple large metropolitan areas begin experiencing year-over-year price declines at the same time, it suggests that the housing market is becoming more fragile. And once price declines spread beyond a few isolated markets, they tend to influence buyer psychology. Buyers become more cautious, sellers become more flexible, and momentum begins to shift. That shift doesn't show up in headlines right away, but historically, it's one of the earliest signs that a housing market is moving from expansion toward a more uncertain phase. Shrinkflation has reached the housing market. There's another, less obvious factor contributing to what we're seeing right now, and it's something most buyers don't immediately notice. It's a concept known as shrinkflation, and it has officially made its way into the housing market. Shrinkflation usually refers to products getting smaller while prices stay the same. And in housing, it's starting to show up through smaller homes being sold at similar price points. Over the past several decades, the average size of the U.S. home increased dramatically. In the 1970s, the average household consisted of about 3 people living in a home that was roughly 1,650 square feet. Over time, that trend flipped. Household sizes got smaller, but homes kept getting bigger. According to the data, the median size of new U.S. homes has increased by 62% since 1973. This helps explain why homes feel so much more expensive today. Even when the price per square foot, adjusted for inflation, hasn't risen significantly, total home prices increased simply because buyers were paying for more square footage. But that trend is now starting to reverse. Rising construction costs and declining affordability are forcing builders to rethink their approach. Recent analysis shows that single-family homes have shrunk to their smallest size since 2010. Builders are increasingly shifting towards smaller, more affordable starter homes. Zillow reports a 9.5% increase in single-family homes with fewer than 3 bedrooms. In addition, some builders have introduced new detached homes that are 300 to 500 square feet smaller and $50,000 to $75,000 cheaper than traditional builds. Rather than maximizing square footage, builders are focusing on optimization. Formal dining rooms are being replaced with larger kitchen islands, and oversized primary bedrooms are being sacrificed in favor of additional smaller rooms. This isn't necessarily about cutting corners. It's about making homes that buyers can still afford in an environment where prices, taxes, insurance, and utility costs have all increased. The result is a market where homes may cost roughly the same as before, but offer less space. And that's another sign that affordability pressure is forcing structural changes across the housing market.
Inventory, insurance, and interest rate risk. Despite price declines in some markets, it's important to zoom out and look at the national picture.
Across the U.S. as a whole, average home prices are still up about 6.3% year over year. At the same time, the cost of owning a home has risen sharply in other ways. Existing homeowners are now paying roughly 21% more for insurance than they were just a few years ago, largely due to higher rebuilding and construction costs. In the short term, those costs are unlikely to come down, and that continues to put pressure on affordability, even in markets where prices have started to soften. There is, however, one potential silver lining. Housing inventory has been steadily increasing from the pandemic lows reached in 2021. More listings mean buyers have more options than they did during the peak of the frenzy. But inventory alone doesn't tell the full story. A major wildcard is what happens to interest rates next.
If mortgage rates move lower, that could immediately spark renewed demand. More buyers would re-enter the market, competition would increase, and prices could be pushed higher again. At the same time, lower rates could also unlock supply. Many homeowners today are sitting on mortgages around 3% and are unwilling to sell if it means taking on a 7 to 7.5% loan. But if rates fall closer to 4 to 4.5%, some of those sellers may finally be willing to list their homes. That could help ease inventory constraints and partially offset new demand. This creates a delicate balance. Lower rates could both increase demand and release supply at the same time, making the next phase of the housing market especially difficult to predict. And that uncertainty is exactly why timing and strategy matter more than ever right now.
What you should actually do. After all the data, the cycles, the price declines, and the uncertainty, the obvious question becomes simple. What should you actually do right now if you're thinking about buying a home? The first thing to understand is that this market is very different depending on your time horizon. The risks look very different if you're planning to stay in a home for a long time versus if you're only planning to live there for a few years. In a market like this, the safest approach is to only buy a home if you're confident you can comfortably afford it and plan to keep it for at least 10 years or longer. That long time horizon matters because housing markets don't move in straight lines. Prices can stagnate or fall for years at a time before recovering. If you're buying with the expectation that prices will continue rising in the short term, that's where risk increases significantly. Especially late in a cycle, short-term price appreciation becomes much less predictable. This is why buying a home you don't intend to live in for a long time is particularly risky right now. Transaction costs alone are substantial. Between closing costs, agent fees, maintenance, property taxes, insurance, and potential price declines, short-term ownership can quickly turn negative. For buyers who are only planning to stay in a home for 1 to 7 years, the data becomes even clearer. Numerous studies show that in most U.S. markets, renting is often cheaper than buying in the short term, even when rent feels expensive. Several rent versus buy calculators indicate that it can take anywhere from 10 to 20 years to truly break even on a home purchase once all costs are accounted for. That includes the opportunity cost of tying up a down payment, ongoing ownership expenses, and the potential returns from investing the difference elsewhere.
This doesn't mean buying is a bad decision. It means buying should be treated as a long-term lifestyle choice, not a short-term financial trade. Another important factor is flexibility. Renting gives you the ability to move without being exposed to market risk. In a period where prices are uneven, inventory is shifting, and interest rates remain uncertain, flexibility has real value. There's also a psychological aspect that's easy to overlook. Many buyers feel pressure to purchase simply because prices are high or because they're afraid prices will go even higher. But buying out of fear is rarely a good strategy. Markets don't reward urgency. They reward patience and preparation. If you're determined to buy, the focus should be on fundamentals. Buy a home you can afford even if prices stagnate. Make sure your monthly payment fits comfortably within your budget, not just at today's income level, but with room for unexpected expenses. Avoid stretching financially just to get into a particular neighborhood or property type. Late-cycle markets tend to punish buyers who overextend the most. It's also worth recognizing that today's market already offers more negotiating power than it did just a few years ago. Rising inventory means buyers in many areas can negotiate on price, request concessions, or ask sellers to cover closing costs. That doesn't mean every seller will budge, but the days of having no leverage at all are slowly fading in certain markets. Another key consideration is expectations. Even if prices don't collapse nationally, long periods of flat or modest growth can have the same practical effect. A home that doesn't gain value for 5 or 6 years still represents an opportunity cost if your capital could have been deployed elsewhere.
This is especially relevant when mortgage rates remain elevated. Higher rates increase monthly payments, reduce affordability, and amplify the cost of overpaying. For existing homeowners, the decision is different. If you already own a home with a low fixed-rate mortgage and your payment is manageable, there's often little reason to rush into selling. Housing should first and foremost be a place to live, not a speculative asset. However, homeowners who are considering selling should be realistic about pricing. The market is less forgiving than it was during the pandemic boom. Overpriced listings are sitting longer, and price reductions are becoming more common. Understanding local inventory levels, days on market, and recent comparable sales matters more now than it did a few years ago. Ultimately, the biggest takeaway from all of this is not that a crash is guaranteed, it's that the margin for error is shrinking. Late-cycle markets don't collapse overnight. They weaken gradually, first through affordability, then through inventory, then through buyer psychology. That's why caution matters. The goal right now isn't to perfectly time the bottom, it's to avoid making a decision that only works if prices continue rising indefinitely. If you buy because it improves your life and fits your finances long-term. If you rent, understand that waiting is not failure. In many cases, it's a rational response to an uncertain market. Housing decisions should reduce stress, not increase it. And in a market like this, the people who come out ahead are usually the ones who stayed patient, stayed flexible, and didn't let fear dictate their choices. If this video helped you understand what's really happening beneath the surface of the U.S. housing market, consider hitting like. It helps this analysis reach more people who are trying to make smart, informed decisions. If you want deeper, data-driven breakdowns like this, not hype, not headlines, just the numbers and the risks, subscribe to the channel. New long-form videos are coming that dive into housing, affordability, debt, and the real forces shaping the economy. And let me know your thoughts in the comments. Are you buying, selling, renting, or staying on the sidelines right now? Your perspective helps guide what we cover next.